Welcome to This Explainer. Okay, listen, if you've ever started investing and felt like you were getting absolutely nowhere, trust me, you are definitely not alone. The honest truth, compounding kind of sucks at the beginning. You put in money every single month, you log in to check your balance, and it looks like it's barely moving at all. It is exactly like trying to push a heavy, stalled car. For those first few minutes, you're sweating, your legs are completely burning, and the car is barely inching forward. But once you finally get it rolling, momentum takes over and suddenly it's so much easier. Well, that is compounding. But the thing is, nobody really tells you how long you have to struggle before that momentum actually kicks in.
Picture this. Let me introduce you to someone named Veronica. She's 28, she's making decent money, and she has done everything perfectly by the book. She's invested $200 every single month for the past 5 years without ever touching it. But when she checked her account recently, she had about $14,000. Her immediate thought was, is this even worth it? I mean, 5 years of strict discipline, and she could blow through that money in just a couple of months if she wanted to. This is exactly the moment where most people throw their hands up and quit. They think the math is completely broken or they're just doing something wrong. But Veronica isn't doing anything wrong, actually. She just hasn't reached the breaking point yet, because compounding works like acceleration, not simple addition. Okay, let's dive right into this. To understand exactly when that breaking point happens, we're going to unpack a highly structured framework called the 7-5-3-1 rule. 7 years, 5 categories, 3 phases, and 1 increase. These 4 pillars predict exactly when the math stops crawling and starts exploding. Let's start right off the bat with the first pillar, the number 7. 7 years, time and consistency. 7 years is the absolute minimum amount of time you need to commit before compounding starts to feel like it's actually working for you. Psychologically, this is the threshold where you finally stop treating your portfolio like a daily scratch-off ticket and start treating it like a growing tree. Think about it. You wouldn't judge an oak tree by how tall it is in year 2, right? You'd wait to see its growth in year 7. And the data backs this up. When researchers looked at the S&P 500 going all the way back to 1926, they found that if you invested for any random 1-year period, you had about a 74% chance of turning a profit. That's not bad. But if you stretch that out to a 7-year period, your chance of making money jumps to over 95%. In fact, in every single 7-year period in the history of the S&P 500, the average annual return was positive. 7 years simply smooths out the chaos. Furthermore, a massive Fidelity study analyzed over 1.5 million retirement accounts and found that just staying invested for 7 years without making major changes yielded 60% higher balances than those who frequently messed with their approach.
That brings us directly to the second number in our framework, 5.
5 categories. Building resilience. Time alone won't save you if you gamble everything on one hot tech stock, watch it double, and then crash 60%, because remember, making that back requires a 150% gain. That is gambling. It's not compounding. You need structural defense across 5 distinct assets. Your foundation is the broad market indexed. Think funds like the S&P 500, making up about half your portfolio. Then allocate roughly 20% to dividend-paying stocks, which essentially feed you cash even when the broader market stalls. Next, you want about 10% in small and mid-cap stocks. Historically, they've returned 11.9% compared to the large caps' 10.2%. Add another 10% in international exposure, since, the US makes up less than 60% of the global market. And finally, 10% in defensive assets like bonds to act as a crucial safety net. Vanguard's data actually proves that this exact structure reduces volatility by 20%, and less volatility means less panic, which keeps you safely in the game. Now, let's shift our focus internally to the third pillar, the number 3. 3 phases, surviving emotional traps. Because here's the thing, even with the perfect timeline and the perfect 5-category portfolio, your own emotions are absolutely going to try to sabotage the math across a very predictable psychological timeline. Phase 1 is doubt, usually hitting right around years 1 and 2. Your balance looks tiny, you see your friends making quick money day trading, and you seriously start to wonder if compounding is just a scam. Phase 2 is frustration, popping up in years 3 and 4. You've invested thousands of dollars, but the growth feels painfully linear. You honestly just want to pull your money out and buy a car, because hey, at least that feels like tangible progress. And finally, phase 3 is panic, and this happens when the market crashes. We really need to use hard data to combat this panic phase, because it is by far the most dangerous. Look at the numbers here. During the massive 2008 crash, the market dropped 37%, but it fully recovered by 2013. In 2020, the market dropped 34%, but recovered by August of the exact same year. That's incredible. If you panic and sell, you permanently lock in those temporary losses. A huge study by the financial research firm Dalbar tracked investors over 20 years. They found emotional investors earned just 4.3% annually, while the S&P 500 returned 8.2%. The people who reacted emotionally literally cut their wealth in half. Historical crashes always recover. Selling out early destroys your future wealth. Which brings us to the final, absolutely crucial number of the framework: 1. 1 increase, the wealth accelerator. Think of your investments kind of like a bench press. If you lift the exact same weight every single week for a year, your muscles just adapt and you hit a hard plateau. But if you add just 5 tiny pounds, you never stop growing. Well, your money works the exact same way. Static contributions lead to static growth. Look at the stark difference here. Let's say you invest a flat $300 a month for 30 years at an 8% return. You'll definitely build some moderate wealth. But look what happens when you introduce just a 5% annual increase to that contribution. In year 2, you add an extra $15 a month, literally the cost of 2 coffees. But over 30 years, that tiny, barely noticeable annual bump pushes your ending balance up to nearly $800,000. It almost doubles your wealth. A report by Charles Schwab backed this right up, showing investors who increased contributions by even just 1% a year ended up with 25% more wealth after 2 decades. It is truly exponential. Now, to prove that this rule, and definitely not luck, is the absolute hero of wealth building, look at this stark contrast. We've got Tom. Tom is 35, starts with $400 a month, and strictly follows the 7-5-3-1 rule. He commits the time, he diversifies, he stays calm during the dips, and he bumps his contribution by 5% every year. He retires with over $750,000, and honestly, compounding did way more work than he did. Then there's Jake. Jake starts with the exact same $400 a month. But Jake panics during a market downturn, stops contributing so he can buy a car, and never increases his monthly input. Jake retires with just $320,000. That's less than half of Tom's wealth. Systematic discipline absolutely crushes emotional reacting every single time. So, how do you actually implement this today? Well, here is a clear, highly actionable 5-step roadmap to put this entire framework on autopilot. Step 1. Commit to 7 years. Seriously, write it down right now and make it completely non-negotiable. Step 2. Restructure your portfolio into those 5 categories we just discussed. Step 3. Automate your contributions so you don't ever have to rely on willpower. Step 4. Plan for your emotions. Decide right now, today, what you will do when the market inevitably drops so you don't panic sell later. And Step 5. Schedule your 1 annual increase. Put a permanent reminder on your calendar for every January to bump your contribution by 5%. So the really crucial takeaway here is this. Compounding feels incredibly slow at first, simply because it is supposed to be slow at first. That's not a bug in the system, it's a feature. It is purposefully designed to filter out the impatient. I challenge you to open up your investment account right now and evaluate your portfolio against this rule. Will you let impatience filter you out, or will you let discipline build your wealth? Remember, compounding doesn't care at all about what you want today. It heavily rewards discipline over instant gratification. Thanks so much for joining me on this explainer, and I'll see you next time.